Welcome everyone to the Principle of Accounting class. This is the brief summary of the basic accounting that everyone must learn. Before you start creating a study timetable that gives you goals and a time in which to achieve them. Having a study timetable as you study is greatly motivational. Learning objectives. Identify the activities and users associated with accounting. Explain the building blocks of accounting, ethics, principles, and assumptions. State the accounting equation, and define its components. Analyze the effects of business transactions on the accounting equation. Describe the 4 financial statements and how they are prepared. Accounting is the systematic and comprehensive recording of financial transactions pertaining to a business. Accounting also refers to the process of summarizing, analyzing and reporting these transactions to oversight agencies, regulators and tax collection entities. The financial statements that summarize a large company's operations, financial position and cash flows over a particular period are a concise summary of hundreds of thousands of financial transactions it may have entered into over this period. Accounting consists of 3 basic activities. It identifies records and communicates the economic events of an organization to interested users. Let's take a closer look at these 3 activities. As a starting point to the accounting process, a company identifies the economic events relevant to its business. Once a company identifies economic events, it records those events in order to provide a history of its financial activities. Recording consists of keeping a systematic, chronological diary of events, measured in baht and satang. In recording, company also classifies and summarizes economic events. Finally, company must communicate the collected information to interested users by means of accounting reports. The most common of these reports are called financial statements. Who uses accounting data? The financial information that users need depends upon the kinds of decisions they make. There are 2 broad groups of users of financial information: internal users and external users. The first one, internal users. Internal users of accounting information are managers who plan, organize, and run the business. These include marketing managers, production supervisors, finance directors, and company officers. In running a business, internal users must answer many important questions. To answer these and other questions, internal users need detailed information on a timely basis. Managerial accounting provides internal reports to help users make decisions about their companies. Examples are financial comparisons of operating alternatives, projections of income from new sales campaigns, and forecasts of cash needs for the next year. External users are individuals and organizations outside a company who want financial information about the company. The 2 most common types of external users are investors and creditors. Investors, owners, use accounting information to decide whether to buy, hold, or sell ownership shares of a company. Creditors, such as suppliers and bankers, use accounting information to evaluate the risks of granting credit or lending money. Indicate whether each of the 5 statements presented below is true or false. 1. The 3 steps in the accounting process are identification, recording, and communication. 2. Bookkeeping encompasses all steps in the accounting process. 3. Accountants prepare, but do not interpret, financial reports. 4. The 2 most common types of external users are investors and company officers. 5. Managerial accounting activities focus on reports for internal users. 1. True. 2. False. Bookkeeping involves only the recording step. 3. False. Accountants analyze and interpret information in reports as part of the communication step. 4. False. The two most common types of external users are investors and creditors. 5. True. Sarbanes-Oxley or SOX is a governing law enforcing listed companies of American Stock Exchange in order to protect investors from creative accounting and extend scope of responsibility of CEO and CFO on internal control and verification of financial report. SOX consists of 5 areas of legal subject matter including 1. Corporate responsibility for financial reports, 2. Disclosures in periodic reports, 3. Management assessment of internal controls, 4. Real-time issuer disclosures, and 5. Criminal penalties for altering documents. Corporate governance guideline that managers and directors had to be responsible for correctness of financial statement with sufficient data disclosure. For Thailand, corporate governance's principles were adopted in bubble economy era in 1997. Thailand had to borrow some money from IMF and it was the condition that Thailand had to have corporate governance as defined. Since then, Thailand has developed its corporate governance regularly. Generally accepted accounting principles. The accounting profession has developed standards that are generally accepted and universally practiced. This common set of standards is called Generally Accepted Accounting Principles (GAAP). These standards indicate how to report economic events. Thai accounting standards and financial reporting standards are announced by Thailand Federation of Accounting Professions (FAP) and correspond with the International Accounting Standards (IAS) and the International Financial Reporting Standards (IFRS). Measurement principles. GAAP generally uses one of 2 measurement principles, the historical cost principle or the fair value principle. The first one, historical cost principle. The historical cost principle, or cost principle, dictates that companies record assets at their cost. This is true not only at the time the asset is purchased, but also over the time the asset is held. For example, if Mr. Yoon purchases land for $100,000, the company initially reports it in its accounting records at $100,000. But what does Mr. Yoon do if, by the end of the next year, the fair value of the land has increased to $400,000? Under the historical cost principle, it continues to report the land at $100,000. Fair value principle. The fair value principle states that assets and liabilities should be reported at fair value, the price received to sell an asset or settle a liability. Fair value information may be more useful than historical cost for certain types of assets and liabilities. For example, certain investment securities are reported at fair value because market price information is usually readily available for these types of assets. Assumptions provide a foundation for the accounting process. 2 main assumptions are the monetary unit assumption and the economic entity assumption. Monetary unit assumption. The monetary unit assumption requires that companies include in the accounting records only transaction data that can be expressed in money terms. This assumption enables accounting to quantify, measure, economic events. The monetary unit assumption is vital to applying the historical cost principle. This assumption prevents the inclusion of some relevant information in the accounting records. Economic entity assumption. An economic entity can be any organization or unit in society. It may be a company, a governmental unit, a municipality, a school district, or a church. The economic entity assumption requires that the activities of the entity be kept separate and distinct from the activities of its owner and all other economic entities. To illustrate, Sally Ryder, owner of Sally's Boutique, must keep her personal living costs separate from the expenses of the business. Quick Test 1. Congress passed the Sarbanes-Oxley Act to reduce unethical behavior and decrease the likelihood of future corporate scandals. 2. The primary accounting standard-setting body in the United States is the Financial Accounting Standards Board, FASB. 3. The historical cost principle dictates that companies record assets at their cost. In later periods, however, the fair value of the asset must be used if fair value is higher than its cost. 4. A business owner's personal expenses must be separated from expenses of the business to comply with accounting's economic entity assumption. Answer: only the third question is false. The historical cost principle dictates that companies record assets at their cost. Under the historical cost principle, the company must also use cost in later periods. The accounting equation, and define its components. This is one of the most important topic for principle of accounting. Assets equals liabilities plus owner's equity. The accounting equation applies to all economic entities regardless of size, nature of business, or form of business organization. An asset is anything a business owns that has monetary value. The common characteristic possessed by all assets is the capacity to provide future services or benefits. Assets are divided into short-term current assets and long-term fixed assets and long-term investments. Current assets, cash and resources that can be converted into cash within 12 months of the date of the balance sheet, or during one established cycle of operation, include money on hand and demand deposits in the bank, e.g., checking accounts and regular savings accounts. Petty cash. If your business has a fund for small miscellaneous expenditures, include the balance in that account here. Unrestricted cash. Short-term investments, also called temporary investments or marketable securities. These include interest or dividend-yielding holdings expected to be converted into cash within a year. List stocks and bonds, certificates of deposit and time deposit savings accounts at either their cost or market value, whichever is less. Accounts receivable, the amounts due from customers in payment for merchandise or services. Inventory includes raw materials on hand, work in progress, and all finished goods, either manufactured or purchased for resale. Prepaid expenses, goods, benefits or services a business pays for in advance of actual use. Examples are office supplies, insurance, etc. Long-term investments, which are holdings the business intends to keep for at least a year and that typically yield interest or dividends. Included are stocks, bonds and savings accounts earmarked for special purposes. Use appropriate category description as opposed to stocks, bonds. Fixed assets, which are resources a business owns or acquires for use in operations and not intended for resale. Assets should reflect any depreciation and amortization from the original costs of acquiring the assets. Other asset tangible assets, assets with physical forms such as buildings, vehicles and office equipment that are not consumed during the course of doing business are tangible assets. These assets are used in the process of doing business and are depreciated over time. Tangible assets are often listed under plant, property and equipment on the balance sheet, and are considered high liquidity assets because they can easily be converted to cash. Intangible assets, assets with no physical form, such as a business reputation, company know-how, industry knowledge and name recognition, are referred to as intangible assets. These assets are not listed on the balance sheet, nor are they considered liquid assets, but their intrinsic value adds to the credibility of the business, which can equate to a higher business valuation. A business whose reputation takes a hit can find itself needing to sell off its tangible assets to stay afloat, so these assets should be protected. Intellectual property, a variation of an intangible asset. Intellectual property includes trademarks, patents, brand names, logos, formulas, inventions, and other creative communications. These properties are generally covered under copyright law to protect them from imitation and infringement. A company that infringes on another company's intellectual property rights can face heavy fines and judgments if a civil suit is filed. Again, like intangible assets, intellectual property is not included on the balance sheet, but without the information intellectual property provides, a business would not be nearly as profitable. Liabilities are all debts and obligations owed by the business to outside creditors, vendors or banks that are payable within 1 year. They are accounted for as short-term, current, and long-term liabilities. Current liabilities. List all debts, monetary obligations and claims payable within 12 months or within one cycle of operation. Typically they include the following: accounts payable, amounts owed to suppliers for goods and services purchased in connection with business operations. Notes payable, the balance of principal due to pay off short-term debt for borrowed funds. Interest payable, any accrued fees due for use of both short and long-term borrowed capital and credit extended to the business. Taxes payable, amounts estimated by an accountant to have been incurred during the accounting period. Payroll accrual, salaries and wages currently owed. Prepaid income or other income received that obligate your organization to do specified things that you have not yet accomplished. Examples: ticket revenue received for an event that has not yet happened, or a grant received that is for a specific project you have not yet completed or initiated. Long-term or non-current liabilities. Notes payable, list notes, contract payments or mortgage payments due over a period exceeding 12 months or one cycle of operation. They are listed by outstanding balance less the current position due. The ownership claim on total assets is owner's equity. It is equal to total assets minus total liabilities. Here is why: the assets of a business are claimed by either creditors or owners. To find out what belongs to owners, we subtract the creditors' claims, the liabilities, from assets. The remainder is the owner's claim on the assets, the owner's equity. Since the claims of creditors must be paid before ownership claims, owner's equity is often referred to as residual equity. Increases in owner's equity in a proprietorship. Owner's investments and revenues increase owner's equity. Investments by owner, or the assets the owner puts into the business. These investments increase owner's equity. They are recorded in a category called owner's capital. Revenues are the gross increase in owner's equity resulting from business activities entered into for the purpose of earning income. Generally, revenues result from selling merchandise, performing services, renting property, and lending money. Common sources of revenue are sales, fees, services, commissions, interest, dividends, royalties, and rent. Decreases in owner's equity. Drawings. An owner may withdraw cash or other assets for personal use. We use a separate classification called drawings to determine the total withdrawals for each accounting period. Drawings decrease owner's equity. They are recorded in a category called owner's drawings. Expenses are the cost of assets consumed or services used in the process of earning revenue. They are decreases in owner's equity that result from operating the business. In summary, owner's equity is increased by an owner's investments and by revenues from business operations. Owner's equity is decreased by an owner's withdrawals of assets and by expenses. The figure below expands the basic accounting equation by showing the items that comprise owner's equity. This format is referred to as the expanded accounting equation. Transactions. Business transactions are a business's economic events recorded by accountants. Transactions may be external or internal. External transactions involve economic events between the company and some outside enterprise. For example, Campus Pizza's purchase of cooking equipment from a supplier, payment of monthly rent to the landlord, and sale of pizzas to customers are external transactions. Internal transactions are economic events that occur entirely within one company. The use of cooking and cleaning supplies are internal transactions for Campus Pizza. Companies carry on many activities that do not represent business transactions. Examples are hiring employees, responding to emails, talking with customers, and placing merchandise orders. Some of these activities may lead to business transactions. Employees will earn wages, and suppliers will deliver ordered merchandise. The company must analyze each event to find out if it affects the components of the accounting equation. If it does, the company will record the transaction. To demonstrate how to analyze transactions in terms of the accounting equation, we will review the business activities of SoftBite, a smartphone app development company. The following business transactions occur during SoftBite's first month of operations. Transaction 1. Investment by owner Ray Neal starts a smartphone app development company which he names SoftBite. On September 1, 2022, he invests $15,000 cash in the business. This transaction results in an equal increase in assets and owner's equity. Transaction 2. Purchase of equipment for cash. SoftBite purchases computer equipment for $7,000 cash. This transaction results in an equal increase and decrease in total assets, though the composition of assets changes. Transaction 3. Purchase of supplies on credit. SoftBite purchases for $1,600 from Mobile Solutions headsets and other computer accessories expected to last several months. Mobile Solutions agrees to allow SoftBite to pay this bill in October. This transaction is a purchase on account, a credit purchase. Assets increase because of the expected future benefits of using the headsets and computer accessories, and liabilities increase by the amount due to Mobile Solutions. Transaction 4. Services performed for cash. SoftBite receives $1,200 cash from customers for app development services it has performed. This transaction represents SoftBite's principal revenue-producing activity. Recall that revenue increases owner's equity. The two sides of the equation balance at $17,800. Service revenue is included in determining SoftBite's net income. Transaction 5. Purchase of advertising on credit. SoftBite receives a bill for $250 from the Daily News for advertising on its online website but postpones payment until a later date. This transaction results in an increase in liabilities and a decrease in owner's equity. Transaction 6. Services performed for cash and credit. SoftBite performs $3,500 of app development services for customers. The company receives cash of $1,500 from customers, and it bills the balance of $2,000 on account. This Transaction 7. Payment of expenses. SoftBite pays the following expenses in cash for September: office rent $600, salaries and wages of employees $900, and utilities $200. These payments result in an equal decrease in assets and owner's equity. Transaction 8. Payment of accounts payable. SoftBite pays its $250 Daily News bill in cash. The company previously, in Transaction 5, recorded the bill as an increase in accounts payable and a decrease in owner's equity. Observe that the payment of a liability related to an Transaction 9. Receipt of cash on account. SoftBite receives $600 in cash from customers who had been billed for services in Transaction 6. Transaction 9 does not change total assets, but it changes the composition of those assets. Note that the collection Transaction 10. Withdrawal of cash by owner. Ray Neal withdraws $1,300 in cash from the business for his personal use. This transaction results in an equal decrease in assets and owner's equity. Observe that the effect of a cash withdrawal by the owner is the opposite of the effect of an investment by the owner. Owner's drawings are not expenses. Summary of transactions. Each transaction is analyzed in terms of its effect on the three components of the basic accounting equation. B. Specifies the items within each component. Congratulations. The two sides of the equation must always be equal. Analysis. Congratulations. If you feel a bit shaky on any of the first transaction, transactions made by Mr. Yoon for the month of August 2022 are shown below. Prepare a tabular analysis which shows the effects of these transactions on the expanded accounting equation. 1. The owner invested $25,000 cash in the business. 2. The company purchased $7,000 of office equipment. Describe the 4 financial statements and how they are prepared. Companies prepare 4 financial statements from the summarized accounting data. 1. An income statement presents the revenues and expenses and resulting net income or net loss for a specific period of time. 2. An owner's equity statement summarizes the changes in owner's equity for a specific period of time. 3. A balance sheet reports the assets, liabilities, and the income statement reports the revenues and expenses for a specific period of time. The income statement lists revenues first, followed by expenses. Finally, the statement shows net income or net loss. Net income results when revenues exceed expenses. A net loss occurs when expenses exceed revenues. Although owner's equity statement. The owner's equity statement reports the changes in owner's equity for a specific period of time. The time period is the same as that covered by the income statement. Data for the preparation of the owner's equity statement come from the owner's equity columns of the tabular summary and from the income statement. The first line of the statement shows the beginning owner's equity amount, which was 0 at the start of the business. Then come the owner Balance sheet reports the assets, liabilities, and owner's equity at a specific date. The company prepares the balance sheet from the column headings of the tabular summary and the month-end data shown in its last line. Observe that the balance sheet lists assets at the top. The statement of cash flows provides information on the cash receipts and payments for a specific period of time. The statement of cash flows reports 1. The cash effects of a company's operations during a period, 2. Its investing activities, 3. Its financing activities, 4. The net increase or decrease in cash during the period, and 5. The cash amount at the end of the period. Reporting the sources, uses, and change in cash is useful because explain the career opportunities in accounting. Public accounting. Individuals in public accounting offer expert service to the general public, in much the same way that doctors serve patients and lawyers serve clients. A major portion of public accounting involves auditing. In auditing, a certified public accountant (CPA) examines company financial statements and provides an opinion as to how accurately the financial statements present the company. Taxation is another major area of public accounting. The work that tax specialists perform includes tax advice and planning, preparing tax returns, and representing clients before governmental agencies such as the Internal Revenue Service. A third area in public accounting is management consulting. It ranges from installing basic accounting private accounting. Instead of working in public accounting, you might choose to be an employee of a for-profit company such as Starbucks, Google, or PepsiCo. In private or managerial accounting, you would be involved in activities such as cost accounting, finding the cost of producing specific products, budgeting, accounting information system design and support, and tax planning and preparation. You might also be a member of your company's internal audit team. Forensic accounting uses accounting, auditing, and investigative skills to conduct investigations into theft and fraud. It is listed among the top 20 career paths of the future. The job of forensic accountants is to catch the perpetrators of the estimated $600 billion per year of theft and fraud occurring at identify the activities and users associated with accounting. Accounting is an information system that identifies records and communicates the economic events of an organization to interested users. The major users and uses of accounting are as follows. Management uses accounting information to plan, organize, and run the business. B. Investors, owners, decide whether to buy, hold, or sell their financial interests on the Explain the building blocks of accounting, ethics, principles, and assumptions. Ethics are the standards of conduct by which actions are judged as right or wrong. Effective financial reporting depends on sound ethical behavior. Generally accepted accounting principles are a common set of standards used by accountants. The primary accounting standard-setting body in the United States is the Financial Accounting Standards Board. The monetary state the accounting equation and define its components. The basic accounting equation is assets equals liabilities plus owner's equity. Assets are resources a business owns. Liabilities are creditorship claims on total assets. Owner's equity is the ownership claim on total assets. The expanded accounting equation is Assets equals liabilities plus owner's capital, owner's drawings plus revenues, expenses, owner's capital. Analyze the effects of business transactions on the accounting equation. Each business transaction must have a dual effect on the accounting equation. For example, if an individual asset increases, there must be a corresponding 1. Decrease in another asset, 2. Increase in a specific liability, or 3. Increase in owner's equity. Describe the 4 financial statements and how they are prepared. An income statement presents the revenues and explain the career opportunities in accounting. Accounting offers many different jobs in fields such as public and private accounting, governmental, and forensic accounting. Accounting is a popular major because there are many different types of It looks like you've put a lot of work into this video. Keep up the good work.